I'm Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and recent developments in energy markets. We've got a very special guest today, Paul Sankey from Sankey Research. He's going to tell us about the future of oil, but quickly I'll go around the room. We've got Salih Yilmaz in Dubai, where it's already dark. We've got Patricio Alvarez and Will Hares with me here in London. Fernando Valle is joining from 731 Lexington. And Paul, I believe you're in Brooklyn from some of the chat we were having prior to the startup here. But, we have had a very interesting ride over the last 12 months in the oil market. About a year ago it was 130 a barrel. Today we're flirting with 83 and change. So, what happened over the last 12 months, and where do you think we go from 83 as you look at the rest of the year, Paul?
I think, we obviously we're still got a lagging effect from China having surprised everyone to the downside for the past couple of years with the COVID stuff, which was a total head scratch. Even by Chinese standards, that one was confusing. Now I'm reading that the Chinese, I think I read this on Bloomberg this morning, that the Chinese leadership are stunned by the pace of recovery in China. Of course, you have to double think all these things. So if China's coming back strong and oil's not getting out of the kind of 80 Brent type range, it's a bit concerning. The other thing is that, rumors of the loss of Russia were obviously overstated. So whatever they've tried to do to reduce Russian exports haven't had that big an effect. And then the other, well-known classic is obviously the very warm winter that we had. Particularly in Europe, so there's really nothing you can do about that. So I would say those are the main things. You can get into arguments about the dollar, about concerns about recession outlook and everything else, but I tend to see oil as pricing synchronistic. So I'm going to try to say synchronistically, pricing in real time. You know what I mean? Oil to me kind of reflects what's going on today because it's a real very highly traded major commodity, biggest single traded commodity in the world. What's going on in the market tends to be reflected in the price, and that's one of my standard lines, which is the only good number in the oil market is the oil price. So all of this controversy about, for example, the DOE data, which has always been highly confusing as well, doesn't change the fact that we are where we are with the oil price. And the continuation of that thought is that the only good number on demand is refining margins. And actually, they look pretty good. So demand looks pretty good. Supply seems to be holding up. The other thing is there's just major consensus that we'll get a very strong second half to the point where it concerns me just because everybody's saying it. But we'll see. There's plenty of reasons to believe in that argument.
Very interesting. Reminds me of a mentor of mine who always used to say the best forecasting tool was a ruler. Maybe you see it a little differently, but there were some interesting headlines on Bloomberg this morning talking about Goldman Sachs, and they talk about this idea of, with quite high confidence, they see a spike in oil prices over the next 12 to 18 months. I think the general tone of the conversation at International Energy Week here in London that's been going on is quite bullish, particularly in the second half of the year. What are the factors in your mind that put us in that more bullish environment, or what are the factors that might be headwinds to that story in your view?
Well, I think the inside baseball view is that Damien, who had a very high reputation on Wall Street, quite rightly, for calling the barrel counting at Goldman here in New York, has gone to work for a hedge fund. So there's a bit of a concern that they've lost sort of the main barrel counter. Now, having said that, Damien was super bullish all through last year, and it kind of didn't work. I don't know what he's saying now, obviously, but for Jeff Curry to be bullish is not very market moving at the margin. That's kind of where everybody expects him to be. So there's a bit of a concern that we've lost really one of the leading voices in oil market modeling here. The IEA is kind of useless, as because they don't forecast OPEC, which is slightly important. So although their balances for the second half look crazy, I mean, they've got Q4 3 million barrels a day undersupplied, they haven't put any account of changes in OPEC in that number essentially. So that undermines the number. But having said that, everybody, and I know a lot of people have been to Saudi recently, and plenty of Saudis think that Saudi want to see the price closer to 95, which probably means 100 over the course of this year. And I do think Saudi held back because of the uncertainties into winter, with the combination of not knowing how many barrels you would need for cold winter and how many barrels you would lose with all the various headlines around Russia, which became very focused on the 5th of February product export ban. Those things sort of haven't showed up, but now I think there's more clarity for Saudi to be able to say, okay, let's organize OPEC to get this price to a better budget balancing level, which we think is 95. So I think that's probably one of the most bullish things out there.
Salih, I want to bring you into the conversation. You were in Saudi Arabia just last week with our friend Joe McMoneagle from the International Energy Forum there, and you heard from OPEC, IEA, and numerous others who were in the room. Do you agree with that assessment?
Yeah, actually, I was in Saudi yesterday as well. There's a lot going on in Saudi, and it's definitely one of the popular destinations from Dubai because there is so much going on. And when you're there as well, it is very clear that the transformation in the country is very much underway, and it is being funded by higher oil prices. So I certainly agree with Paul that they probably do have a price in mind. I haven't really, in the conversations that I have had, that number hasn't come up. But like we've been talking about, a $90 a barrel for OPEC perhaps is what they were shooting for. Perhaps more recently, $80 a barrel is the lower limit that they would be targeting. I think the fiscal break-even for the country is probably a little lower than that. At least that is what the IMF suggests in their annual reports. But obviously, I mean, the higher the better. And some of the projects that they have in mind that they are aiming to finish, I mean, NEOM being one of the bigger and more important ones, I mean, obviously does need higher oil prices given the sheer size of these projects. So, but I do agree with Paul that, this is probably one of the most bullish points that, I mean, we don't really have an OPEC meeting, like a full OPEC meeting until June. But we know that they very much would like the current elevated pricing environment to continue, because not just Saudi Arabia, the rest of the producers are very much enjoying this $80 barrel per plus Brent price environment.
If I could try to synthesize some of the narrative from International Petroleum Week, I think there's a lot of focus on Russia rather than Saudi Arabia, and there seems to be this sense that part of the reason things get tighter is some kind of constraint on Russian output that so far doesn't seem to have materialized. So, Paul, when you kind of use your crystal ball, how do you think about the geopolitical angle, and is there anything concerning for you with the dynamics around Russia?
Well, I mean, my line in my research has been, we're in World War III, right? You're in it, you've been in it for a year, and let's see how it goes from here. But that was the first year, and at the moment, it's not getting resolved. You would expect an increase in military activity as you come into spring, which we've clearly seen. And then you've got this wild card of the way the world as part of World War III is realigning. So essentially you have new multipolarity, which would be Saudi with Russia, which I think is more friendly at a headline level than it is in reality. And we hear that Saudi's not too happy that Russia is pumping so much oil, and is worried about maybe organizing a tighter oil market in the context of the Russian relationship, which, as you know, historically has been absolutely abysmal and is one of the huge changes that we've seen in global oil over the last decade, the inclusion of Russia in OPEC plus, obviously. And then, of course, you have the China-Russia polarity, which is very live at the moment as part of World War III, because you've got this crazy controversy around the Wuhan lab leak. and how China reacts to that and how upset they get with that. And I know Wall Street guys who are worried about that think it may tip China to be, more pro-Russia and more anti-US. So we'll see which way that goes. I've talked to the State Department, and they like to remind me that China needs the US very much, so headline China-Russia is more about China securing energy supply, and I think it's a better the devil you know model, where they want to keep in relations with Putin because they don't know what's behind him. And of course, ultimately, China is highly dependent on export markets, which could, collapse if something bad happened with the US. So it's a very tense situation, but one which is sort of hanging together, and we kind of stumble forward all at the same time with basically record, depending on how you look at it, record low US unemployment and what seems to be in Brooklyn Heights a booming economy. And I always highlight that the New York economy is not the fast growing economy here. The two fastest growing economies in the world are Saudi and Texas. So it's a tough one, and it's a little bit disappointing, as you referenced in some ways, that oil is not doing better, especially against expectations that it would be, acting very well by this time after the Russian export ban should have kicked in.
Very interesting. Fernando, I want to bring you into the conversation. What do you make of the geopolitical dynamics? And, there's always been this idea that, or at least in the last 10 years in the market, that the U.S. shale would sort of respond and sort of be the supplier or the marginal supplier in the market. Is that time period over, and are you also looking to some of these geopolitical factors as a key driver over the next 12 to 24 months?
Absolutely. I think that's probably the biggest driver in the short term. I agree with Paul. In the long term, the supply side looks imbalanced on our end. There's just been a lack of investment in new capacity outside of U.S. shale since really 2013, 2014, when we had the first dip in oil prices. The other thing on, it's not less geopolitical, more global, but the interest rate hikes, I think, when Paul talks about how disappointing it is that oil hasn't gone higher, I agree that EIA data is very spotty, but when you look at the consumer data on other parts of the equation, be that the U.S. consumer, the European consumer, or less so the Chinese consumer, because of all the lockdown issues, and we're still seeing how that will reverberate. But the U.S. and European consumer are getting to an exhaustion level. We've seen now the number of repossessions and used cars rising, obviously a lot fewer home sales with interest rates at much higher levels. And the expectation that we would start easing or pivoting seems to be out the window over the last couple of weeks. And in fact, we're getting back to we may go back to 50 basis points hikes, which then begs the question of how will that impact global consumption. And as far as U.S. shale being the marginal producer or the swing producer, I think that narrative is long gone. I mean, for two reasons. First, the cost inflation has been massive, but second, and probably most importantly, we've drilled through a lot of the better acreage in U.S. shale. If that is the Bakken or if that is the Eagle Ford, that both of those areas, you've seen degradation on the overall well quality, and that's happening now in the Permian to a certain extent. We just saw yesterday with Chevron, Paul was in the room there. Their Delaware Basin wells all were significantly gassier and at a much lower productivity level than they expected. They've alluded to improving by moving to New Mexico in the Delaware Basin. Remains to be seen. There are bigger wells there. There's also higher gas content. There are gas flaring restrictions. There are pipeline restrictions. So I think the amount of growth we can get out of U.S. shale is capped. We're never getting to those 18, 19 million barrels a day that some predictors had in 2018, 2019.
Will Hares, I want to bring you on, just get some European perspective. Is an Aker BP type of company able to help fill some of the supply shortfall that may be out there in the future? And also in Europe, there's this whole other layer to the conversation about windfall taxes and things like that. So is that discouraging new upstream investment in the region?
Yeah, just firstly on Aker BP, in the near term, the answer is yes. There's a nominal amount of production that will be coming out of Norway this year, largely as a result of Johan Sverdrup Phase 2, which came on stream in late December. This is one of the largest offshore projects in the world, and that'll push overall plateau full field production to around 750,000 barrels a day. So yes, there will be a little bit of a few 100,000 more barrels a day coming out of Norway as a result, and then deeper into the end of the decade, they also have major projects ongoing, largely as a function of Norway's COVID-inspired massive tax rebates on new project developments, which were submitted right before the clock struck midnight on December 31st last year. And then secondly, on the windfall taxes, absolutely, we are seeing an immediate pullback in capex from the obvious North Sea exposed players. So Harbour Energy, EnQuest, Serica, they have all unanimously cited the UK's energy profits levy, which is an extra 35% tax, as the major reasons why they're optimizing their capital budgets, i.e. delaying or canceling new wells being drilled or well re-entries. And so yeah, the short answer for your question is yes, there's an absolute impact we are seeing felt in the UK, but it is worth acknowledging that the UK is a deeply mature basin, and it is already in terminal decline. And we expect UK to produce next to no production, by the end of 2050.
Paul, I want to swing back around to you after hearing those comments from Will and Fernando. What do you make of this idea that industry has been underinvesting in new supply? How concerned are you about a supply shortfall over the medium term? And if you are concerned about it, what's the solution in your mind?
Well, higher prices. So that's how you get back to growth in the US, I think, allowing for the productivity issue. You've got to remember that while marginal productivity is decreasing, the industry has still produced growth over the past couple of years with lower capex. So, and of course that is partly a function of them drilling better inventory from a more consolidated industry. So there's a number of counter currents that are on there. You've consolidated the Permian. As a result, they've high graded their drilling. Their drilling performance, therefore, has been better relative to capex levels. But ultimately, you're stalling out on oil supply growth. And so it would take higher prices to increase activity. The higher the price goes, the inventory situation just completely changes, obviously. So what you're really understanding is that there's an $80 limit on available inventory, and that's going to be a problem for US growth. The other thing is that if you look around the places in the world that can grow production 100,000 barrels a day, the list is incredibly short. It's actually not bad exercise to do the exercise, because there's only really at most 10 countries in the world that can grow 100,000 barrels a day of oil production. The obvious ones are Saudi, UAE, probably the only spare capacity that's out there. And then you get into things like Iraq, Iran, you start going and say Russia. You've got Canada, which doesn't seem to be doing anything. But by this time, you're getting into the 2 million type levels of production, and you're really getting to a challenged potential to produce 100,000 barrels a day of growth, with the obvious exception of Guyana. So the supply side, there's absolutely no question. It's hugely challenged, and you're going to get higher prices over time, assuming that are going to reflect the fact that we've got an oil supply problem. In the 2000s, I was very against the peak oil argument. I felt that it was a function of high prices not being high enough to encourage more production growth. But you got those prices, and you got the surge of mega projects, which were an economic disaster. Now, barring Guyana, there's almost no oil mega projects being developed, because the companies that once bitten, twice shy And I think it'll be a long time. I should say Kazakhstan as well is obviously a major project, a mega project development. But I don't think there's any further mega projects that are really visible now that you mentioned Johan Sverdrup as well, that are really on the docket. And if you look at Saudi spending, we're looking here at 5 years to add 1 million barrels a day of capacity from ostensibly the largest reserves holder in the world, the other largest reserves holder in the world being Venezuela. And you're watching the situation in Nigeria with the election yesterday, thinking nothing's going to change there. In fact, one of the worries I have about the future of the world is that there are no examples of failed states to our knowledge since the Second World War, failed states that have actually recovered and made a comeback. So Russia looks like it's going down the failed state route. South Africa, failed state. Nigeria, failed state. Venezuela, failed state. Several of those have major implications for oil supply. And then it just becomes a question of what price does demand break. And I think the reason Saudi would like a higher price is because they see that there's appetite for their oil at higher prices than where we are now. And it's not obvious that we crushed the economy globally with very high prices last year, although that's highly distorted by the actions of the Fed and other central banks. So it's complicated, but the big picture is pretty simple. There's not enough supply and there's probably too much demand.
What do you make of the balance between CapEx and capital returns? Do you think companies are getting it right? Would you encourage companies to be investing more in CapEx right now to prepare for a higher price future?
No, not really. I mean, I think that our view has been that I wrote the so-called Renaissance thesis of US E&P in 2017, and we haven't wavered from that view that essentially the companies should have a very low reinvestment rate and should essentially force the price higher in order to get better returns. Now, you've got there last year with ROCE's, return on capital employed, in the 15% range. But for a stock to be attractive, that's where they need to be on a sustained basis. And you saw those returns last year as a result of a Russian invasion. And I'm forgetting what the price peaked at, but I think it was about $137, Brent, that we peaked at on a day basis last year. All I remember is I was doing an interview live on the Tokyo Open, and from down the street here on Brooklyn High Street with a coat over my head to stop the crazy people interrupting my interview. And I had to think to myself, if I'm doing the Tokyo Open talking about the oil price, it's probably a top. And that was right. But it's quite possible that over time we'll squeeze back up to that level, because one of the interesting things out there is that as the energy crisis has unfolded, energy understanding and education has improved, and people are now beginning to understand what the problem is. And 5 years ago, I could stand in a bar and people would say we should just transfer to solar and wind. Now people talk about interruptibility, the same people in the same bar. So I think the quality of understanding of the challenge has increased. And my long-term argument has always been that what we really need is some sort of liquid solar power that occurs naturally, that's highly energy dense in highly portable form. Of course, what I'm talking about is oil. So you've already got, a solution in oil if you can improve the public image of oil and use it appropriately, which is a way of saying I'm bullish on the long-term oil sector. That said, I still like the companies generating a 15% plus return, because I don't think investors will accept less than that, given the challenges that the sector does face from energy transition.
Are those bars in Brooklyn, or are they in London, or are they in Texas?
All of the above. I mean, I think Texas people, as you know, is highly dependent on wind, and Texas has learned some lessons as regards interruptibility for sure. But obviously, naturally, their people are more naturally pro oil and gas. In Europe, by contrast, people are structurally opposed to 100% consensus against oil and gas, and are prepared to pay more money. The result, you can be structurally opposed to oil and gas, but you're going to have to pay a lot more money to do that. My personal view is I just don't see how the European economy, with such weak demography, can generate economic growth at very high energy prices. And ultimately, the result so far has been they end up burning more coal. So things are not going too well there. I think we're all looking at, in the Bloomberg chat room, at Greta being arrested at an offshore wind farm today as well, because it's like, it's a bit like Occupy Wall Street. You know, they never actually had an agenda. They never had an alternate agenda that we could support or deny. And if you look at, say, for example, AOC's Green New Deal, or what Greta says about how we should manage energy, it's kind of garbage. And, you know, you've got to go and listen to Chevron and see what they're doing to understand what the kind of adults in the room are actually trying to do to help a situation that we all want to help.
You know, I'll just pipe in and just say that if you're not following the solar stats, solar is growing incredibly fast in Texas. They're going to overtake California as the largest solar market in the U.S. probably within a month or two, right? It's just growing super fast there. And with that, I have a question to tie in what's going on in the gas market. Over here in Europe, I do think this idea that natural gas can be this bridge fuel, particularly after what we've seen with Russia and Ukraine, I don't think that idea is ever going to work in Europe again. But maybe in the US, you can still have this idea that gas is this fuel that sort of sits between both worlds. So what do you make of how gas plays with the sort of energy transition? And, you know, do you see a completely different set of fundamentals for the gas market versus the oil market?
Well, gas is naturally more abundant, right? So oil, you need specific temperature and pressure, and you need a trap more or less, depending on how you look at it. Whereas gas, if you have too much pressure, you get the oil turns to gas, and so just fundamentally, there's more reserves available. I've always railed against people just, you know, saying I'm anti-fossil fuel, because you end up putting natural gas in with coal, which doesn't make any sense, and you blatantly need to use more natural gas in order to allow for highly interruptible energy supply sources like solar and wind. So if we could only just, I mean, it's just so obvious, and it's just a basic physical fact that if you want to use approximately as much energy as people expect to use with their iPhones and their cars and whatever else and their TVs, you've got to have a combination of either natural gas and nuclear as a base load, and then, you know, as much wind and solar as you can build from coal in China using coal-fired Chinese steel, you know. So that's all a bit of a joke in the grand scheme of things, but ultimately natural gas is huge. And my perception is not quite the same, if I understood you correctly, because I believe in Europe they're coming to accept that you do need natural gas to offset the grid issues that you get with too much solar and wind. I think that's understood. It's just that they had a disaster that was related to this, which is that Putin felt that Europe was hugely dependent on natural gas as a result of more solar and wind, and therefore thought he could get away with quickly invading Kiev. He didn't make it 50 miles, and the rest is history. But I think in Europe, you see even the EU and other major organizations are now recognizing that natural gas is an important bridge fuel. The messaging of the IEA, I don't really understand. I think they're trying to be alarmist by saying we can't invest any more in fossil fuels, and that's not helpful. I assume it's illustrative to say how far we are off pace in terms of changing emissions, but I don't think it's helpful. I think they should be promoting natural gas, promoting nuclear, promoting energy efficiency, number one, actually. The best thing you can do is be more energy efficient.
Yeah, absolutely. Okay, so Patricio, let's bring you in real quick. I know we're approaching the end of the time here, but what do you make of Paul's comments, and how's your read on gas as a bridge fuel?
So I think I have to sit somewhere in the middle between Rob's comments and Paul's comments. I do believe that perhaps the bridge fuel nature of natural gas in Europe wants to be reduced, but as Paul said, I think that there's still a long way to go to phase out gas in Europe, and I think that's just the fundamental struggle of decarbonizing all of the demand for gas. So 2/3 of the demand for gas comes from other stuff rather than power, right? So it's for heating and it's for industry, and there's no readily available substitute for natural gas, particularly in heating. With green hydrogen projects is still in a pilot phase and still with no proof of concept, I'd say, to be scaled up throughout the system. So that would say that's sort of the points against it, and in favor of shortening the bridge fuel is that solar and wind will displace gas in the power mix, in the electrification part of things for sure. But again, I don't see the EU sort of leaving gas completely anytime soon. There is efforts to sort of wean itself off Russian gas, and even those will take Europe up to 2027. If everything goes well, then we will be independent from Russian gas by 2027, and that's largely reliant on displacing Russian gas from the power mix rather than the energy mix that's seen as a whole. So I think I would sit somewhere in the middle.
Salih, I know you've got to run, but let me just swing over to you real quick. What about gas in the Middle East? Are all the Middle Eastern producers still primarily focused on the liquids market, or do they see a real opportunity to help meet some of this shortfall that Patricio just talked about, or whether you want to think about it as a transition fuel or not? Where does gas fit in the mix for the European producers?
The short answer is I think they do. I mean, as you know, Qatar is one of the biggest gas producers and an LNG producer. But when we look at Saudi Arabia and the UAE as well, we know ADNOC has been pretty clear about its ambitions to increase its gas production. Unlike Saudi Aramco, ADNOC hasn't actually listed as the parent company, but they previously listed their distribution unit, and they are about to list their natural gas unit as well, which I think also speaks to the fact that they really are getting more serious about natural gas. When we look at Saudi Arabia, just earlier today, there were some headlines that they are actually looking at some options to acquire a stake in an LNG facility. Abroad. And we know that they are planning to spend about $100 billion in the next decade in increasing their natural gas production. This is not going to be used for LNG like Qatar. It's mostly going to be used domestically and for blue hydrogen. But I mean, again, a long answer to your question, but the short version is that yes, they are. I mean, as much as they are doubling down on crude oil, they are getting a lot more serious in natural gas as well.
Okay, Paul, we're going to give you the last word, but we'll do a quick round robin on the idea that you brought up with this notion of this Greta Thunberg and the environmentalists protesting a wind farm. But I believe it's a Norwegian project that they was the point of their focus. And I guess the question is, we have all of this tension between energy transition and energy security that's present in the market right now. And if you look out over the next 12 to 18 months, are you more concerned about energy transition or concerned about energy security, and which of these ideas is going to be the sort of one that the market really latches on to? So we'll come to you first.
I think hands down security has to be the priority over sustainability, and I think part of the reason why we are where we are right now is because that hasn't been the case over the last few years. I think ESG has sort of been loud and upfront, and the concept of energy security has unfortunately been pushed to the back burner. But we're seeing that being resolved with slowing of energy transition strategies by some of the majors, like we saw with BP, and that 100% will not have gone unnoticed by some of their peers.
Patricio, next to you, energy transition versus energy security.
Yeah, so I would be a +1 for Will's stance. Also, security, I think it's been underlooked via underinvestment. And the only thing I would add to Will's point is perhaps that it's also economic factors that are driving this return towards like the old economy and those sort of fossil fuel driven investments, because investors will follow the money. And I can tell you, because my utilities here in Europe have also cut their investments in renewable expansion and also in grids a little bit, and that's all because interest rates are going up. So if oil keeps delivering better returns in times of higher interest rates, then that just makes the economic sense.
Fernando, up to you.
I'll riff on what Paul said, but I think energy efficiency is ultimately the most carbon efficiency that we can have. So creating something that is the most energy efficient, that has the most return on the energy put in, will actually be the fastest way to decarbonize the economy, and finding ways to get it to improve on those processes. And then I think that it's not just energy security as well as energy access, because most people in the world don't have energy access as reliably as we do, and those people will want to improve their standard of life, and that is one of the ways you get to energy security, is by decreasing the disparity in energy access between people across the world.
Okay, Paul, we'll give you the sort of closing remark and last word. Where do you see things panning out on the energy security, energy transition mixture over the next couple of years?
Well, I always quite like the Obama line, which was all the above. So I support absolutely all that you guys have said there in terms of the short and long term, with security and crisis management obviously being the near-term problem. One of the more interesting stories of the week for me was the revelation, I think it was in the FT, that Shell had considered moving its headquarters to Houston. And it just struck with me, because I had been writing that BP and Shell should move their headquarters to Houston as of 2020, really, that you shouldn't bother trying to run a major oil company from Europe, because it would just be a totally thankless task, and that the investors in Europe don't want you, so why would you stay there? The governments don't want you, so why would you stay there? So it was interesting to me that Shell had at least discussed this idea at a senior level, but then actually made the mistake of not deciding to actually do it, because I believe they should. But the point I'm making is that the capital flows are going to reflect that anyway. And I wanted to ask more. You actually came up with it about the Abu Dhabi IPO this we've seen in gas this week. You see the capital flows, obviously the IPO of Aramco. Big clients here are talking a lot about Middle Eastern IPOs, and so what they're doing is they're not necessarily investing in Shell and BP, other than a relief rally that you've seen over the past 6 weeks, where they're like, okay, Shell and BP, particularly BP, are backing off this disastrous let's get out of oil and gas strategy. When you're an oil and gas company, you just can't do that. And so as the companies have backed off to the point where they were even considering moving to Houston, so the money flows have come back in somewhat to those companies. But in reality, the big money flows are going into the Middle East in order to buy the reality of the future, whilst just leaving companies that are essentially arguably greenwashing behind. So very interesting times, and you just follow the cash, right, and you can see where it's going.
All right, we'll have to leave it there. Paul Sankey is a terminal client. He's a green dot right now. So if you have follow-up questions, he's easily found on the terminal. And we want to thank you for joining us so much. If you have questions for any of us, hit BI Go and ask us a question. If you're not a member of our energy client chat, reach out to any one of us. We're happy to get you included on that. It's fun, a lot of active discussion on the kinds of topics we talked about here today. And I want to thank everyone for their time. We'll do this again in 2 weeks. We do them always on the first and third Wednesday of every month. So thank you so much for joining us, Paul. It's been a lovely discussion.
Thanks a lot.